let's bring in Rob Lauzon. He's the Chief Investment Officer at Middlefield Capital. Thanks so much for being with us.
Yeah, good to be back.
So at times, the equities have actually outperformed crude, and that was the case for much of the rally. And then recently, they're starting to lag. Why is that?
I think there's two reasons. One is the forward curve. So looking out how you can hedge oil, the futures market, where a lot of activity happens that investors that trade stocks don't even see, is backwardation, downward sloping. So even though crude is $90 today, if you want it to sell crude next year or the year after, you're getting 83, 79. So as an equity investor, I have to model that as an average price of $80 for the next 5 years, not 90. So then you're just not going to give the benefit of the doubt of that extra $10 yet. Time is maybe your best friend here. The longer we stay above 80, the more that excess cash flow is not embedded in these shares that are not moving yet. And the excess cash flow will come to investors in two ways. Earnings, so even the same multiple on a higher stock price, because earnings will go up even on the same multiple. And then two, the companies have very little debt now, so they can't even pay down debt. They're just going to do a special buyback, a special dividend, increase their dividends. Yeah. So those are shareholders' returns, it's patient money. Energy is really a patient sector now.
And that's interesting because for a long time it was a no-touch sector, and you've been in this for so long, and you yourself diversified for a little while, and you've come back in a major way to the energy sector. How would you characterize sentiment right now, and whether it's still under-owned?
Yeah, so sentiment by the producers and the companies is, I think, at all-time record levels, being positive. They know they're not at the whim of the bank anymore. They have no debt. Prices are good. Efficiencies, technology has allowed Tourmaline, for example. I met with them last week at a conference. Wells that took them 30 days to drill, they've drilled 5 wells now in 6 days each.
Wow.
So that's just like technological productivity. In every business, it's happening in energy to squeeze efficiencies. Now, on the investor side, it is what it is. There's always now going to be investors that sit on the sidelines and say, I don't want to own fossil fuels or natural gas or oil, and that's fine. So let's take that as an opportunity, given the backdrop I just laid out. These are healthy companies, so if it's a smaller group that's going to benefit from it, that's fine with me. Over time, those total returns, those high cash flows will come back to the investors. So just be patient with it. I think it's a must-own sector. Oil demand has gone from 87, 88 million barrels a day when I started in the industry to 100, 101, 102. Now they're saying 104. We're still driving around in cars. That will slowly change. We saw the UK try to push out maybe to 2035, how quickly they want to move to EVs, because there's a lot of risk in trying to push things too quickly. We're still flying in planes. The biggest industry of the world is energy, for plastics, for refineries, for all these other industries. It's just, we all want to do it more sustainably, which is another way that these companies can benefit, is through carbon capture and some of these green technologies, which is still on the come for Canadian investors. So there's a lot of good things happening in the industry, and I think for investors that want clean companies, low debt, high free cash flow, the kind of the Warren Buffett way, energy screens as the best sector right now. So I'm not saying to have 100% of your money in it, but in a diversified portfolio, don't be afraid to have 10 or 15% in energy infrastructure, energy producers.
And cheap.
And cheap.
But something I wonder is, why are they so cheap? Because all those metrics are so obvious. Is it because, lack of interest, or is it warranted that they should be cheap because they're at the whim of something they can't control, where, their number might be coming up in 10, 15 years?
Yeah, I think it's a bit of both. I think for sure investors on the demand side, the buyers of the equities, are worried that there is a terminal value to the business. So the business will no longer exist in 7 years because we can't cook with natural gas-fired stoves, things of that nature. So I guess the second point is, all of these companies have the ability, whether it's Whitecap with their carbon capture technology, whether it's Enbridge moving natural gas around, and if hydrogen is the new molecule that we move around in 20 years, we'll do it in their pipes anyway. You have to move it somehow. You can't, so it's all of these businesses have longevity, and I think it's mispriced.
We are seeing oil prices, West Texas around 90, Canadian oil prices around $70. For US, is that just a pit stop to 100? Do you care about that, or is anything, call it above 80, kind of gravy for you?
Yeah, the sweet spot, Goldilocks, is $80 because it's not too hot, not too cold. And if we get through 100, most recessions are caused by high oil prices because it is the biggest industry in the world. That's an input to everybody's business. We don't want oil over 100, and that will cause a major recession if it happens for a long time. And we don't want oil under 50. One of my favorite names is Whitecap. They run their business on $3 gas and $50 oil. So below 50 is worry for me. Above 100 is worry. And so maybe 80, I'm just picking that. But the Saudis have come out and said they want it to defend $70 plus. So you've got all these reasons why oil should trade at 70 plus, but we don't want it too hot. Governments get involved, regulation gets involved, and recession risk as it gets too high. So it's nice to earn that cash flow as we see $90 oil, but most companies would just rather have less volatility and be in that $80 range.
And Whitecap is an example of a stock that has actually managed to keep pace with the returns in crude relatively over the past couple of months. How are you assessing names with torque? So Whitecap is one of them. If you want to make sure that you are going to capture it, what's another name you would like?
It's looking for growth. Headwater would be another one. So those are my two favorite ways to play oil right now because I get cheap valuation, I get runway of reserve life or inventory of oil wells. So Whitecap, I see 30 years of inventory in their new Montney and Duvernay area that they bought off Shell last year. And I see the same with Headwater. They continue to come out with more land that they've quietly amassed in the Clearwater play. So those two names, I see longevity, I see a cheap multiple. They're giving me a 6-7% dividend yield, which is growing, and very low debt. So it checks all the boxes that I'm looking for. Some investors don't need dividends. Mm-hmm. We're an equity income shop. We're a dividend shop at Middlefield, so that's a must for us.
Oh, before I let you go, last time we chatted Enbridge, this dividend yield doesn't seem to be doing anything for anybody. No. Other than if you own it, you're clipping 7.5% if you buy it today. But what's it going to take?
Yeah. One is, I think half of it is lower bond yields and lower interest rates, which even though the Fed has come out, I don't think they're going to hike it much more. They just want to send the message that we might have longer interest rates, higher interest rates for longer, which is that expectation of trying to slow down inflation in the economy into a soft landing. I think that's actually a good thing, and I think it'll work, because if they were to hike the overnight rate to 7%, that will cause a credit crisis and a recession. They have a better shot of a soft landing, which they're trying to engineer by and I do think we'll have interest rate cuts mid-year next year and more in 25. So when rates come down, when the 10-year in the States gets back to 3.5 to 4, not between 4 and 5, names like Enbridge naturally will work. Enbridge is a very large company, but they have $100 billion in debt. So they have to pay higher interest on that debt. So everything works better for Enbridge when rates are coming down. And I like this acquisition that they did because it's gas utilities, which is less volatile and should garner a higher multiple in the industry. So, we bought some on the financing. We continue to have Enbridge as one of our key ways to play energy infrastructure. And I believe that the stock will be back 53, 54 level, but you do need the rates to come down. So that's going to start, in our opinion, mid 24. So we're 7-8 months away from patient investing again.